a successful option strategy with the help of option Greeks that I am going to show you. So before going to the session, I'll just put few words about the Smart Finance. So Smart Finance is a company situated at Chennai. We are engaged in the research and analysis of the stock market, and through our research process, so whenever we talk about the term research, we must come with some outcomes. So through the process of our research, we have found out many innovative techniques on intraday, on option trade, on option arbitrage trade, on pair trade. Same way, we have also devised 22 option technique for Indian market. For Indian stock market, 22 complex option strategies we have devised for the trader. Now coming to our activities, we have softwares, we have books and literatures, we conduct seminars. We do not have any broking activity. We are not associated with any broker. So I will talk about our upcoming events after some time. Let me take you to the learning session. So whenever we are forming the option strategy, there are many ways we can form the option strategy. We can make delta as neutral whenever we are expecting that intrinsic value should reward us. That time we should form delta as a neutral. And whenever we form with respect to volatility, we must initiate with respect to vega neutral. Whenever we wish to make money from time value decay, we have to make it as theta neutral. So I am not using the term theta 0 or delta 0 or vega 0. I am saying that delta neutral. Neutral doesn't mean that it should be 0. Neutral means you should devise a strategy which well suits to your risk appetite. That is the term of the delta neutral or vega neutral or theta neutral. So in this particular session, I have in this particular session, I will be taking the delta neutral approach. So before teaching you this concept, I must show you some trade outcome as compared to this associated with this delta neutral. So here I am going to show you some trades from which is being done by me in my personal account. This is my name reflects here. This is our office address also reflects here. So it is a genuine contract note, including my PAN number and other things. So still, if you have suspicion about that, I cannot help it out. However, it is a genuine contract note. Earlier, I have initiated one option strategy with 7,600 put along with the future buy. So this strategy is being closed. One new strategy is being initiated. You can look into this part. 312 on 10th of this month, 10/7/2014. 7,700 call option. 6 lots are bought at 55 and future is being sold at 7566.6. This strategy I have closed it today. 6 lots here being bought and 1 future is being sold. So you must, considering 200 point of losses we have taken approximately on the future. However, same time I have got some good gains in these options, so it offsets that trade. Same time also this bank nifty, we have sold a future, and same time 15,500 call option is being bought with 100 quantity here, 50 quantity here to make it as a delta neutral. This too is being also squared off in the subsequent days. So here it is being sold at 152, and this is being future is being closed here. Similar way, one more strategy also is being initiated with respect to the State Bank of India, wherein I bought the State Bank of India at 2604 here. This is on the day of 17th. So State Bank of India 2604 I bought, and 2550 put option, here 2 lots, and here also 1 lot. So 3 lots, and here 1 lot, 4 lots. So 4 lots of 2550 put option made it delta neutral. It is being taken with an average price of 36, and this is being bought at 2604. And the same strategy is being closed here, wherein the put options has gone with an average price of 50, and the future State Bank of India. At the same time also I sold a call option, 2700 call option also I have sold it here. So with respect to the State Bank of India, I have also sold a 2700 call option at 24.3 on the same day. Put options are being bought, call option is being sold, and along with the future is being bought here. So this is what the trade is being initiated, and the trade has come out with 2700 call option. It has given almost 10 rupees gain. So for here this put option 1 lot has given me 10 rupees, others has given me almost 14 to 15 rupees. 14 into 3 lots here I got, so 42 points plus 10 points, 52 points plus 10, some 62 points I win from this, and some 2560, so 40 points I lost in future. So very next day on the 18th it is being squared off with a good gain. 18th it is being squared off with a good gain. 17th it is being taken. So objective of this pair trade is objective of this option strategy trade is you must form with respect to delta neutral or vega neutral or theta neutral or any of the option Greek neutral. Then you harness the profit once the price move according to your anticipation, and same time if it doesn't move with respect to your anticipation, you will also have a minimal impact on your losses. Fine. So I'll talk about the delta neutral here. So delta neutral strategy can be formed in 3 different ways. One, to keep the delta as 0. Second, you can keep delta as negative. Third, you can keep as delta positive. So these 3 ways you can able to estimate the delta, and based on that you can initiate a strategy. Keeping delta as a positive is recommended in a rising market with low volatility condition. So whenever the prices are rising with low volatility condition, you must form a delta positive. Net delta should be positive, and this positive should not be less than 30%, or the net positiveness should not be less than 3, and same time this net positiveness should not be greater than 10. So 3 to 10 is an ideal range wherein your time value management must be proper, and the low volatility condition, the instrument in which you are initiating this trade must have a volatility less than 20. So if it is you are initiating with Nifty must have a volatility less than 20, then delta positiveness will reward you. Negative delta recommended in the falling market with high volatility. This too also has the same rule. You should keep your net delta with respect to -3 to -10. -10 is a very high level. So that means if 1%, if the net delta is -3, means if the underlying asset, if you have formed a Nifty, if Nifty forms by 1%, if it falls, then your -3 delta means your time value can grow by 30%. That time value component of this thing, you can, intrinsic value of these options can grow by 30%. So 10 delta means, -10 means 1% fall will invite a growth of 100% growth in the intrinsic value component. So 3 to 10 is an ideal level. Same also goes in adversity. Suppose instead of falling 1%, if the Nifty rises by 1%, what will happen? Your net delta, if you have kept it -3, that means your intrinsic value component of that option will reduce by 30%. So this is also one of the situation you need to monitor. And delta zero strategy is initiated in a range bound market where the price finds a resistance and support at 90-degree Gann trend line. So if you, I have already taken one session for WD Gann. If you are using the Gann's concept and 90-degree resistance line is considered as a very toughest level, if you are finding out that yes, resistances are being and supports are being capped in this particular price range, that time delta zero strategy is initiated. Positive delta must be greater than 3%, that already I have told you, and delta positive or negative strategy is formed when trader aims to gain from the underlying asset price movement. So delta neutral means you are going to bargain on the intrinsic value component. So this is the process in which this strategy is being formed. So I'll just form one strategy and show you how it is being formed. So we are going for that particular strategy. What are the informations we required? So I'll just go for the NS India. So if you do not have any software or anything, how you can form one option strategy. I'll also show our software by means of which I can demonstrate one strategy. Assume this is the Nifty future. So I have gone for the Nifty future. Here the cost of carry informations are there, volatility informations are there. So Nifty currently which is having a volatility, Nifty currently volatility is 17%. Currently volatility is 17% per annum. So it is a low volatile market. Low volatile market, price is trending upwards. So it is low volatile market. So now if we are going to form a delta neutral strategy. In a low volatile market, what kind of delta neutral strategy we can form? We can form a delta positive in a rising market with low volatility condition. So this is a price is in the rising trend and we are in the low volatility scenario. So we can form a delta positive option strategy. So this positiveness also minimum 3, maximum 10. This is the positive nature of the delta we can give. So for that we need to take the help of 2-3 parameters. First, the volatility. Volatility is 17%. So this says daily basis, everyday basis, we have 0.88 point of volatility. So 0.88 is the daily volatility. So suppose I wish to hold it for 5 days. 5 days I wish to form a strategy which I can hold maximum for 5 days. So I will be taking the square root of 5 multiplied with this 0.88. So this is the volatility I can expect in the Nifty which is currently at a price of 7771, round it to 7771, and in this particular I'll take this divided by 100, so it is 153 point of oscillation I am expecting in the Nifty. So 7771, this is the level, and I am expecting 153 point of price oscillation in the Nifty in coming 5 days. So I may be getting the Nifty at a level of 7924 in the upper side. I may be getting the Nifty at a level of 7618 in the downside. So this is the thing I am going to get. Assume if I am selling the Nifty at 7771, 151.53 points I can gain if it falls. If I am buying Nifty at 7771, if my upward anticipation comes true, I can also win 153 points. So 153 points of oscillation is expected in the Nifty. Now we will look into the factor of delta neutral. So delta we required positive. So what is the delta? So delta of a future is 1. Means if you are selling a future, then it will be -1. If you are buying a future, it is +1. Delta of call option varies from 0 to +1, and delta of put option varies from 0 to -1. So this is the delta's nature. So now we got the upper bound and lower bound based on our holding cycle of 5 days. So our holding cycle is 5 days. 5 trading days or 5 days you can say. So 5 trading days our holding cycle. During this our holding cycle, we may expect the Nifty to swing between 7924 to 7618. So how I can form the delta neutral now? So my first choice, if I am in a range bound market, if I am expecting the Nifty to arrest in 7924 to 7618, I can, or below this if it is false, then it will be volatility is going to increase and it is going to have a great move in the downside. If above 7924 it moves, then it may move greatly in the upper side. With this anticipation, if I am forming a strategy with the range bound market expecting these two price points will never come, or if I am taking the GAN 90-degree resistance support also, take the GAN 90-degree resistance and support, square root of this one added with 90-degree factor is 0.5. So if the price moves in this particular zone, so 7859, and same way I will take the square root of this number minus 0.5, which is 90-degree factor. So this is the support. So this is my consolidation band, and if it crosses 7683 to 7859 is my consolidation band for Nifty. If it crosses that, then it can easily touch that 7924. If it falls from there, then it can easily have a fall till 7618. If I am expecting it is a range bound market, how I will form a strategy? So for that I require the delta. So I will be just taking the help of my option strategy software. So to calculate the delta of different strike, and I also want to remind you here, since my off move and the down move having a range of 7924 to 7618, I'll choose the strikes in between this band, 7900 band to 7600 band is the place where I can make the entries, where I can choose the strikes for deciding upon any kind of strategy. So I'll just hit my Greek scanner here. So this gives me the delta of all. So 7700 call option is having this delta of 0.81, 7800, 900, all these things I'm getting. 7900 is having 12 rupees premium, however it is having a delta of 1.19. 7850, 7800, all these premiums I am getting and the delta I am getting. Same way I am getting the put side delta also. 7000, 7700, 600 to 7900 is my point of importance. So from here I am getting 7600 having a delta of minus 0.13, and I have all these levels. Now for the range bound market I am going to form a strategy expecting this is the move. So since I am the last leg of the market, last part of the market, nothing wrong if I'll do in this order: buy Nifty at 7771 and sell call option of Nifty 7800 at a price of 7800 at a price of 41. Then estimate the delta and accordingly you can hedge. Buying one lot future Nifty, one lot, delta as 1. Then I sold a call option. What is the delta of 7800 call option? 0.48. So I sold, so minus 0.482. So this is the delta. So this is the delta of this call option. So which we have calculated here, 4822. So 4822. So this is the delta. By this process my net delta has now come to 0.51. If I buy any of the option which is having a put option having a delta 0.51, my delta will come to 0, considering it is a range bound market. So I will be searching for a strike which having a 0.51. Obviously I got it at 69.65 here, 7800 put which is having 0.5116. So I'll be, if I'll buy a put option of Nifty 7800 at 69 or 70 you can say. So this also has a delta of minus 0.51, 7800 put 5116. So almost I have neutralized this thing to a net zero level. So this is how my delta neutral has formed. Now I'll be calculating what is the liability, what is the profit and losses I'll get. So if I'll just look into this factor, 29 points I have left out here, 29 points till 7800. This 41 is the complete time value. So 9 was a 10, 4, 2 or 6 and 7. So 70 rupees time value I am gaining and 70 rupees I paid. So if Nifty expires above 7800, I will never make any profit. I will never make any losses also. However, if Nifty falls down, so then my liability will be 40 points is being restricted here. So this is having 30 rupees as the 29 rupees as the intrinsic value, having a time value of 162 as 441 and 41 I am getting here. So I will not get, in case of a fall also, I am not going to make any profit here. So my objective of the trade is being solved, but I am not making any profit. Neither I am making any profit nor I am making any losses. So this trade, theoretically it is being correct for writing on an exam and for getting some scores in that, but for a trader it is meaningless. If with respect to the range bound market, if we are expecting for the coming 10 days period, left out days, if we are going to have a range bound market, then this strategy is not going to reward us anything. Fine. So now moving to a stage wherein we are expecting volatility is low, prices are moving up, then have a net delta positive strategy. So the second option what I have left out here, I will be selling the Nifty. Why I sold? Just I want one big delta. So I have just sold a Nifty with a -1 delta. Now I will hunt for a call option and buy multiple lots in such a way that I should have delta above +3. So for that, so if I am just going for 7,850 call option at 23 rupees with a delta of 0.32, so 7,850 call option at 23 rupees, delta of 0.850 call option 0.323, 0.323. So one lot is just neutralizing 30% of that. I want more than 3. So if I am going for say if I am going for say 10 to 11 lots, so my net delta will be this one, so 2.5, so 12 lots, 2.87, minimum I required some 3, so 3 I am getting around 13 lots if I am taking. So 13 lots of this one will be having a time value factor of 23. So 299 points worth of risk I am taking, and I am initiating this strategy. If my assumption comes wrong and Nifty fall down to 7618 level, I'll be just recovering 153 points. I paid 300 points. I'll be getting 153 points. Almost 6, 4 and 1. 146 point I can lose in the coming 5 days if it falls down. However, if it goes to 7924, then my profit will be amazing. So for that, I need to analyze what is the profit I can get. So I sold one lot. I call option, I am buying 7850 by 13 lots and 5 days. So 5 days calculate. If it is going to 7925, what is my anticipated things? 7925, if I am going for that, then I will be having a 37,000 rupees worth of profit. If it falls down to 7613 level, so I'll be having a liability of 7,107, and my profit will start coming once I'll cross that 7847 level. Once I reaches that time only my profit will be started increasing. So till that point I will not be making any profit. Once it crosses that, I will be making some profit. And this is how you should form a option delta neutral strategy. Why I have bought 13 lots here? I want a minimum delta of +3. Why I have bought this call option and brought it? Because the current situation is a low volatile market with price is trending upwards. Though I have very less time left out for the expiry for this month, but it is good that if I can form the strategy in such a way that at least I should get some positive delta of 3 above. So this is how you should form delta positive strategy in low volatile. But if you say that suppose if you are saying that Nifty is having a volatility, assume if it is having a volatility, say it is having 37% of volatility. I will not suggest this strategy. I will not suggest this strategy. Rather, I will suggest the delta negative strategy for this. So based on the volatility, you need to decide which way you have to add the delta, or which way you have to make the delta beneficial for you. Low volatility means with rising market, have a delta positive strategy. Negative delta must be in the high volatile market. Also price trend should be in falling. Delta 0 if a price finds a resistance and supports at a 90-degree trend line, or you can have a range boundness. So this is how delta neutral strategy is formed. So I'll show you some more features of this particular software also. It has an advanced price trend recognizer. Just in the click of mouse, it will tell you each cycle. These cycles are being derived as per the Gann, Elliott and Peonic principle, taking consideration of your volatility. So this particular week, we are expecting that if this uptrend starts at 7784, today it has given a breakout above 7757. If it crosses this uptrend, then this can have a maximum trajectory of 7811. You can have a consolidation for first cycle at 7800 to 7757. This cycle is crossed, means second cycle will start and it can take you to third cycle. At each level of your cycle, you can find out what is the performance of your strategy. If you click here, it will say that at these levels, how much profit you will be making, how much liability you are going to incur. So the strategy what you have formed at each level of this, you can get its profitability and liability picture. So if you are restricting in the first cycle, you will have 6,000 loss here, you have 10,000 loss here, because you have added great amount of value there, 7797 to 7757. If it consolidates, this strategy is going to give you a loss, and this loss will vary between the 6 to 10,000 rupees. If first cycle penetrates, then you will be uptrend wise, you can get some profit. If it is going to 7838, from here onwards your profit will start increasing, and this weekend if you are getting 7879, your profitability will be around 16,000 for this particular strategy. So this is, in this software we have given this feature, and you can have a Greek scanner, what you have seen. Any kind of strategy you can form in this. If you do not have a software, also form the strategy using this particular very simple to understand tools. So simple to understand concepts, when to form a delta positive strategy in low volatility and rising price trend, when to form a delta negative high volatility with falling market, when to form a delta zero strategy, if the price is giving you in a particular range or the range bound situation, you must follow this strategy. And this option strategy software, if you are taking along with all other courses on technical investor and other things, then at an entire package you will be getting at 17,000. And if you want other course materials and intraday and some basic softwares without this option strategy software, then this package costs 12,000 rupees. So besides that, we used to conduct various events, programs. So as you have seen here, there is a free program is being scheduled at Chennai, Mumbai and Bangalore. If you are located in any of this city, please come and join for this program. Consider these things as my personal invitations to you. Please come and experience and learn some of the beautiful techniques. Chennai, it is on 3rd August, Mumbai 10th August, Bangalore 17th August. The locations are being given here. And if you wish to join this program, then better register here so that you can get a personalized invitations from us. If any of your friends are located there also, ask them to come for that program. At least in that process you can help some of the traders to learn some of the innovative techniques. Besides that, we are conducting some paid seminar events also. Our upcoming event for paid seminar is 7th September it is starting. It is at Chennai. 14th September at Mumbai. 22nd, 23rd and 24th we have online events. The topics for those program is outlined here. Fees also are being given here. Those who have already joined any of the paid program, for them we treat them as previous participants. They just want to refresh their knowledge, wants to learn something new. For them we are giving a good discount. Those who are first time joining, for them one fee also we have scheduled. So this is about our products and services. In case if you have any query associated with the products and services, you feel free to call us at this numbers 98403-48971 or 64995823. If you are at Mumbai, then you can call us at this number 810-80-66120 or 9833-293717. So our executives will help you to identify the correct product for you. So maybe all products will not be suitable for you. If you are just focusing on any one particular area, you must take the product which is associated with that particular trading practice. But if you wish to get the complete knowledge, complete things, all softwares along with all course materials, which consisting of 6 printed books, 18 DVDs and all our softwares, then you can opt for any of these two packages. One is just without option strategy software, other is with option strategy software. So this is about our